Over the last 3 decades, Indian IT sector has been one of the biggest wealth creators. And for many Indian investors, IT stocks have been a part of their core portfolio. However, today, after many years, Indian IT sector is facing a very difficult time. It all started 14 months ago when IT index peaked out and then corrected 30% in the next few months. However, the index quickly recovered around 20%. But recently there is again a sharp correction and net the index is down around 30% since December 24 high, making the IT sector one of the weakest performer in the Indian stock market. During this period, while large cap companies have corrected in the range of 20 to 40%, many mid and small cap IT and software companies have corrected 60 to 70% from the peak. By the way, this is not only limited to Indian IT. The entire global IT and software industry is facing a massive sell-off. And the reason is rise of AI. It all started with ChatGPT a few years ago. And today, AI has become one of the biggest threats to IT and software industry where it can potentially cut down a lot of white-collar jobs in the near future. See, today everyone is accepting that AI will have a huge impact in every part of our life. But the problem is, currently the world is divided into two extreme sides. On one side, some people are saying that AI will completely kill the IT and software service business model. On the other side, people are saying that AI will create massive opportunity for the IT and software sector. Now, in the last few days, I've been reading a lot to try to figure out who is right and who is wrong. Because if AI threat is real, as some people are arguing, then Indian IT sector can see a lot more pain ahead. However, if AI threat is over-exaggerated and IT companies can actually benefit from it, then this correction in IT sector can be a great investment opportunity. So in today's video, we'll start with how did this AI narrative actually started and where are we today? Then I want to clear the confusion in terms of difference between the business model of IT service company versus SaaS company. We'll take examples to clearly understand the difference. Third topic is how AI can impact the IT service companies versus SaaS-based company. Here we'll discuss both sides of the argument. And finally, I would share my take on this entire saga of AI versus IT. And what is the right approach? Should you buy IT and software stocks in this correction or should you sell them? Or just hold and wait and watch? It will be a little long discussion, so I hope you will have some patience to hear my point of view. Alright, let's get started. So if you go back to late 2022, when ChatGPT was first launched publicly, it just went viral. It could write emails, it could generate code, it could summarize documents, but at that point, it still felt like an advanced chatbot. Even companies were experimenting with it more for curiosity than for serious production use. But then things started moving very fast. Within months, models became significantly better. GPT-4 improved reasoning, code generation became more reliable, AI tools started integrating directly into the developer environment. GitHub Copilot became assisting programmers in real time. Enterprise started running pilot projects internally. And the narrative slowly shifted from interesting tool to serious productivity enhancer. And then came the second shift. Instead of asking, can AI help employees? People started asking, if AI can do 30 to 40% of repetitive work, do we need the same number of employees? That's when the market started panicking. For decades, IT service companies operated on a relatively simple model. You win a contract, you deploy engineers, you bill either on billable hours or fixed price basis. So more engineers means more billable hours, means more revenue and profit. Now imagine a scenario where one AI assisted engineer can do the work of two. Immediately investors started to worry. Does it mean fewer billable hours? Does that mean lower revenue growth? Does that mean pricing pressure? And this fear is not limited to India. In the US and Europe, companies are openly talking about AI-led efficiency. Some global tech firms have already reduced hiring. And today, productivity per employee is being measured more closely than ever. Then recent updates from Anthropic claim that humans don't need to code anymore. Now whether those projections are realistic or exaggerated, we'll discuss later. But markets don't wait for perfect clarity. Markets react to probability. So even if there's a 30% probability, let's say, that long-term growth assumption of IT services needs to be reset, valuation multiples will adjust. And that's where we are today. The fear is not that IT companies will disappear. The fear is, what if growth slows structurally from say 10-12% to 5-6%? What if margin compress because pricing power reduces? What if clients negotiate harder because AI lowers delivery cost? As a result, Nifty IT, which was trading at a very high P multiple of 36, started derating. Mind you, the valuations were also very high during that period as compared to the median valuation. So today, IT sector is facing valuation derating as investors believe that it can face a major challenge from AI and it's not worth paying a high PE multiple. The big question is, what is a fair PE multiple for the IT sector considering all the headwinds? We'll discuss it later. But before we jump to conclusions, we need to understand something very important. Not all IT companies are same. An IT service company like TCS or Infosys is very different from ER&D company like KPIT or Tata Elxsi or a SaaS or product company like Newgen or Intellect Design. And unless we clearly separate these business models, this entire AI discussion becomes confused. So let's clearly break down what exactly is an IT service business, what exactly is a SaaS or software product business, and why does this distinction matter so much in the AI debate. Before we go deeper into AI impact, we need to clearly separate the Indian tech universe into three broad business models because not all IT companies are same. The first model is traditional IT service. These are the companies like TCS, Infosys, HCL, Wipro. Their core business is helping global enterprise build, maintain and modernize software system. Revenue largely comes from long-term service contract. Billing is either time and material based or fixed price. But in both cases, execution depends heavily on manpower. Growth typically comes from adding more engineers, winning larger deals, improving utilization and increasing billing rate. It is a people-intensive, execution-driven model. Margins depend on employee cost management, offshore mix, and operational efficiency. In simple terms, revenue and headcount are closely linked. Then second model is ER&D or engineering, research and development. This includes companies like KPIT, Tata Elxsi, Tata Technology and L&T Technology Service. These companies are not just doing generic IT outsourcing. They are deeply involved in engineering, embedded system, automotive software, aerospace design, product engineering and digital engineering for manufacturing companies. For example, KPIT works heavily in automotive software, especially around electric vehicle, autonomous system and vehicle architecture. Tata Elxsi works in areas like automotive design, media engineering and healthcare devices. Tata Technology focuses on product lifecycle management and engineering services for manufacturing client. Now the key difference is ER&D companies are more domain specialized. Their work is often embedded into the physical product, be it cars, aircraft, industrial machine, medical devices. So the skill requirement is deeper in engineering and design rather than just enterprise software implementation. The billing model is still service-based and manpower-driven to a large extent, but the value proposition is more specialized and often tied to long product cycles. So while ER&D is technically a service model, it is more niche, more domain-driven, and often less commoditized compared to generic IT outsourcing. Then third model is SaaS or product companies. In India, you have companies like Newgen, Intellect Design, RateGain, and so on. These companies build proprietary software platform. The product is developed once and then sold or licensed to multiple customers globally. Revenue is subscription-based or license-based, often with recurring maintenance income. The scalability here is very different. Once the platform is built, adding incremental customers does not require proportional increase in manpower. That's why SaaS businesses can achieve higher gross margin and strong operating leverage over time. Now, why is this three-way distinction important in AI debate? Because AI does not affect all three business models in the same way. Here, your IP, that is intellectual property, can play an important role in terms of how much the company is insulated from the AI impact. Let's discuss it. Now, when it comes to impact of AI over IT and software companies, there's currently a massive debate going on. The world is divided into two groups. On one side, some people are saying that AI will completely kill the IT sector business model. On the other side, some people are saying that AI will create massive opportunity for the IT sector. The big question is, who is right and who is wrong? To understand this, let's try to understand the arguments from both sides. Let's first take the bearish argument, that is AI will kill IT. The logic here is straightforward. Traditional IT service companies like TCS, Infosys, HCL, Wipro, they operate largely on manpower linked model. Revenue scales with headcount. So if AI tools dramatically improve the coding productivity, testing automation, documentation and maintenance, then fewer engineers may be required per project. And if effort reduces by 30 to 40%, clients will eventually demand lower billing. Even if companies try to protect margins initially, competitive intensity will pass on the productivity gains to the customer. Over time, that could compress the revenue growth and reduce the structural need for large hiring cycles. Now extend this argument to SaaS model. Critics argue that powerful AI agents can now build workflows, generate applications, and configure enterprise systems dynamically. If AI becomes capable of stitching together APIs, managing business rules, and automating the process autonomously, then certain layers of enterprise software could become commoditized. In that scenario, product companies like Newgen Software or Intellect Design Arena may face pricing pressure, especially if their offering is seen as workflow automation that AI can replicate. So the bare case is AI reduce effort, AI services sell effort, SaaS sells software built from code. Now if code itself become a commodity, SaaS companies can never command high margin. That means the business model would bleed badly. Now let's look at the bullish argument, that is AI is an opportunity, not a threat. So the first argument is, this is not the first time market has declared the death of IT. If you look at the dot-com phase of 1999 to 2001, there was massive excitement about the internet changing everything. Then the bubble burst and many technology companies disappeared. So investors concluded that tech spending would collapse structurally. But what actually happened over the next 15-20 years? The internet did change everything, just not in the exaggerated way people initially imagined. Strong companies survived, weak ones vanished, and a much larger digital economy eventually emerged. Then look at the cloud transition phase around 2008 to 15. When companies like Amazon Web Services and Microsoft Azure started scaling, there was real fear that traditional IT outsourcing would become irrelevant. The argument was simple. If infrastructure moves to the cloud, enterprises won't need large service vendors managing on-premise systems anymore. Data centers will disappear and automation will reduce human intervention. As a result, Indian IT stocks corrected sharply multiple times during that period because of this narrative. But what actually happened? Cloud did not kill IT services. It changed the nature of work. Instead of managing physical servers, companies started migrating workload, redesigning architecture, integrating SaaS platform, building cloud-native application, managing cybersecurity in distributed environment. So the work actually evolved, it did not vanish. In fact, companies like TCS and Infosys became large cloud migration partner. The opportunity pool expanded because enterprise needed help navigating complexity. Even in SaaS, there were fear. When cloud-based SaaS model emerged, many traditional licensed software vendors were disrupted. But high-quality companies with strong IP and deep domain integration became stronger because they adapted faster. Microsoft itself is a great example of how it migrated from an on-premise software to cloud and became a $1 trillion company. So history shows a pattern. Every major technological shift creates two reactions simultaneously. This will destroy the old model. This will create a bigger opportunity. Both are partially true. The weak commoditized layers get disrupted. The adaptable, IP-rich, mission-critical players evolve and benefit. Now apply this lens to AI. Yes, AI will automate coding. Yes, it will compress certain low-value activities. Yes, billing models may need to change. But AI also increases the complexity of enterprise system, governance, security, hallucination risk, model monitoring, regulatory compliance, ethical workflows. Large enterprises will not simply plug ChatGPT-like tools into their core banking system or automotive control unit without structural integration. That integration layer itself is an opportunity for Indian IT service company. And on the SaaS side, AI enhancement can actually increase product value. A platform like Newgen Software embedding intellectual document processing or Intellect Design integrating AI-based risk modeling could actually deepen customer dependence rather than reduce it, provided the IP is strong and mission critical. Here we need to understand why is IP important as protection from AI. See, AI is extremely powerful at automating repeatable, rule-based, code-heavy work. It can write code, refactor system, generate workflow, test software, and even design architecture suggestion. So anything that is largely execution-based and manpower-driven is naturally more vulnerable. If output per engineer doubles because of AI tool, then economic value of raw coding hours would fall. But IP changes that equation. When a company owns proprietary platform, domain-specific engines, regulatory compliant architecture, embedded data models, and industry workflow refined over 15-20 years, that is not just code. That is deep domain knowledge. AI can help you write new code, but it cannot instantly recreate 15 or 20 years of domain evolution, trust, and production deployment across hundreds of customers. In simple terms, AI can accelerate building software, but it does not automatically replicate deep domain IP that has been battle tested in real environments. So when people say AI will kill IT, what they often mean is AI will kill the weakest part of IT. But that is true in every technology cycle. .com killed weak business model, cloud killed legacy infrastructure players who did not adapt, mobile killed desktop first companies who ignored smartphones. The question is not whether AI changes the industry. It obviously will. The real investor question is which companies treat AI as a cost threat and which ones treat AI as a capability upgrade layered on top of defensible IP. Because historically, technology shift did not shrink the total opportunity. They actually redistributed it. And right now, markets may be pricing extreme disruption without fully distinguishing between a fragile business model and deeply embedded IP-driven business. That is where the opportunity or the risk will likely sit. Now, considering all the points, let's discuss what you should do as an investor with IT and software companies. To take a call on buy, sell or hold on IT services and software companies, we need to understand that ultimately a stock price is a function of two things: earnings and valuation. Now, historically, traditional IT service companies like TCS, HCL, Infosys, Wipro, they are cash generating, relatively stable, dividend paying business. Now, if we exclude the current uncertainty due to AI, the revenue and earning growth in these traditional IT companies is usually in the range of mid to high single digit or low double digit in normal cycle. Margins are steady, cash flows are predictable. So market typically value them like mature compounders, not hyper growth stories. Since these large cap companies have huge weightage in IT index, we can look at the PE of Nifty IT to understand the historical valuation. So on screener, you can see this historical PE chart where right before 2008 crisis, Nifty IT PE touched peak of 34 and then it tanked to PE of 10. However, it recovered sharply. Then during COVID period, PE fell down, but then Nifty IT again jumped significantly. And now again, it has fallen. However, net the index median PE is around 22. So today, the valuations are at par with the last 20 years of historical median. Now the ultimate question is, if AI impact on IT sector is real, how much can it really impact the terminal earning growth of these IT service company? 10%, 20, 30, 40, 50%? At this point, nobody has an answer. Let me be honest. And second question is, how much time will it take for AI to impact the earning growth? So yesterday I was watching an interview of Dr. Vishal Sikka and he said there's a gap between potential of AI and the actual reality of creating an enterprise ready offering. Whether it hits a particular project or quarter depends on the nature of the situation, and for many complex services, it might take years for these new offerings to show up. He has taken an example where he said autonomous driving was proven at Stanford 20 years ago. Yet today, Waymo still accounts for less than 1% of all taxi-type rides in the US. So ultimately, it's all about AI adoption. How quickly Indian IT companies can adapt to AI. While AI will certainly disrupt some of the existing businesses, it can create massive opportunity for IT companies. Because AI would need to be implemented. And for that, you would need IT companies. In fact, Mr. Sikka also mentioned that India has thrived through disruptions like Y2K, mobile and cloud. And current goal is to adapt to this and make AI a tailwind faster than it destroyed the prior generation of work. The only catch is, this time, the rate of change with AI is much faster. And large cap companies might struggle to cope up with that rate of change. So if adoption is slow and AI impacts the business much more than it creates the opportunity, IT companies can see further PE derating that could be as low as 10-12 PE multiple. In that case, there can be much more pain ahead. However, I am sure that some of the IT companies will adapt quickly and emerge as winner. If that happens, valuation will re-rate. Now here, software or SaaS companies like Newgen, Intellect Design, RateGain are valued differently. SaaS companies have operating leverage. Once the IP is built, incremental revenue can scale faster than cost. However, if the IP itself is not defensible with AI, then entire business would become unsustainable. And that's what the market is fearing about. Now, as far as valuation is concerned, these SaaS companies have always commanded a premium valuation. For instance, Newgen P touched a high of 80. However, with fear of AI, this P has now fallen to levels of 20. Intellect P has derated from 50 to 25 P multiple. So the point is, if AI is really a big threat to SaaS companies and their business model itself is under threat, then there will be much more pain ahead. However, I personally believe that this AI thing is overblown. While some companies would certainly vanish, some will emerge as winner. And when that happens, those companies will create amazing wealth. I'm closely tracking companies like Newgen, Intellect, and there's a lot of investment being done for AI adoption. So I think it is not a time to write off these companies completely. We need to track them closely. Now, as far as technicals are concerned, the chart structure is extremely weak for all IT and software companies. While fundamentals are extremely important, we also need to track the basic price volume action and how the stock price is trading as compared to 50 and 200-day moving average. Today, Nifty IT is at a very important support levels near its last year lows. In the past, it has recovered from the lows. So let's see how it moves now. If the price breaks the support, there can be much more pain ahead. I hope that does not happen. Considering the current situation, I would be cautious in adding IT or software companies as of today. At the same time, I don't want to be over bearish, at least not for the companies that have solid IPs like KPIT or some of the SaaS based companies. So I am holding some of my mid and small cap IT companies. The right approach in my opinion is to wait and watch the development closely. No need to be in a hurry. Let the winners emerge for AI. Personally, I have taken a few decisions in my own portfolio that I have shared in my exclusive weekly video series. Again, the idea is not to give buy or sell call. The idea is that many of you might not get enough time to track the market closely. That's where I try to add value as I spend hours on a daily basis. Plus, I share my own investment thesis. So if I'm buying anything, why I'm buying it, and if I'm selling anything, why I'm selling. Plus, I closely track the quarter results of nearly 200 companies that help in identifying investment opportunities. For more details, you can explore my website or join button of this YouTube channel. Moving on, again, one big lesson from this AI development is it's important to have a right asset allocation with enough exposure to different sectors. You can't blindly bet on a specific sector or a company. That's extremely risky. It's important to have right diversification in portfolio. And before we close this discussion, one last thing I want to discuss. If AI threat is truly as big as some people are predicting, then it will not remain an IT sector issue. It would become a global crisis. For instance, today India's IT ecosystem employs roughly around 50 lakh people. If 40-50% of those jobs disappear, that means 20-25 lakh salaried employees lose income. Mind you, this segment drives a significant portion of urban consumption. Home loan, car loan, SIP, insurance premium, discretionary spending. If jobs vanishes, EMIs get stressed, banks see rising NPA, credit growth slows, real estate demand weakens, auto sales fall, and equity inflow decline. The ripple effect would hit banking, NBFC, real estate, auto, retail, capital market, almost everything. And if the entire world faces massive layoff due to AI automation, it creates a global crisis to a scale that we can't even imagine. In that case, even AI companies won't be able to make money. So everything would become useless, including the stock market. Hence, I would still like to believe that the AI threat is overblown. While it will take away the repetitive jobs, it will create massive opportunities that we can't imagine today. So that's it from my side. Hope you got a good perspective on the latest development on AI and its impact on IT and software companies. Now I'd love to know your views on this. Do you think AI will kill IT and software companies or it will create new opportunities? And what are you doing with IT and software stocks? Buying, selling or holding? Thank you for watching this video. If you find it useful, do share it within your circle. I'll see you in the next video. Till then, take care.